我快要失业了，刚收到通知降薪30%。
I'm on the verge of losing my job. I just got notified that my salary is being cut by 30%, and there won't be any year-end bonuses. This pay cut affects the entire company, more than 200 employees. This month, our company delayed salary payments. Normally, we get paid on the 5th for the previous month's work, but on the 5th, management suddenly held a meeting and announced that salaries would be postponed until the 15th. Even then, only part of the salary will be paid, with the rest, like our performance-based wages, being deferred to next month. Because our projects haven't performed well, next month's revenue is uncertain. Several colleagues in my department have contracts that are about to expire, but HR hasn't told them whether they'll be renewed. Everyone at the company is on edge. The pressure of potential unemployment feels overwhelming. The economy is bad, the company isn't making money, and cutting salaries seems to be the only option. In recent years, China's economy has remained sluggish, and layoffs and pay cuts have been happening across many industries. Now, even state-owned financial institutions under the central government are feeling the impact.
年前跟银行的朋友吃饭，他们偷偷告诉我
Right before Chinese New Year in 2025, I had dinner with a friend who works at a bank. They told me that things will be even tougher this year. Reportedly, 27 banks, including China's 4 major state-owned banks, are implementing across-the-board pay cuts. The new salary system eliminates all earnings above a set base salary, and performance pay, quarterly bonuses, annual bonuses, and project incentives are being completely scrapped. For many positions, just the base salary portion is being reduced by up to 60%. Since bonuses usually make up the majority of total earnings in the financial sector, this means most employees will see their incomes plummet. I asked why this was happening, and my friend explained that even with loan interest rates dropping below 3%, banks are still struggling to issue loans. Without loans, there's no way to make money.
Finance used to be considered a golden industry, but now layoffs are frequent. Many professionals are being forced to switch careers. Some turn to social media, while others look for jobs at state-owned enterprises or in other industries just to make a living. One example is Ms. Tian, a 37-year-old from Xinjiang. She branded herself as a middle-aged finance professional facing unemployment, and started a career as a content creator. She was laid off in November after 14 years at a security firm, and saw this as her chance to start over. On social media platform Xiaohongshu, many unemployed finance workers have shared similar experiences. A TikToker named Cheer Up was laid off from a Shanghai investment bank in October 2024. After 2 months of unsuccessful job hunting in securities and startups, he decided to return to his hometown in Henan. He wrote, "The industry is in turmoil. When expenses exceed income, even the most humane companies will have to cut staff. You have to fight to stay connected and find opportunities wherever you can." Another TikToker, who is a 30-year-old Peking University finance master's graduate, has been unemployed for over 100 days. After more than 30 interviews, he finally accepted a job at a state-owned enterprise. He had to settle for a much lower salary and longer commute, writing, "At 30, I'm starting over from zero." A 37-year-old former investment banker in Shanghai also shared his thoughts online. He recalled how, not too long ago, investment banking was an industry where top graduates and talented professionals from various fields fought to get in. It was thriving, full of energy. But within just a few years, it has become a field people are scrambling to leave. He added, "The higher you climb, the harder you fall." During the expansion phase, top graduates from elite schools and industry experts rushed to join investment banking. Back then, people were confident and ambitious, handling billion-dollar deals over casual conversations. But starting in early 2024, everything changed. People were leaving in droves. For those who still have projects, investment banking now feels like a tasteless meal, too valuable to discard, but too difficult to stomach. The workload has surged. Updates and waiting times are endless. Base salaries are shrinking. Bonuses are just a dream, and constant business trips make people doubt themselves every day. And for those without projects, the uncertainty and fear of layoffs are unbearable. This is just a glimpse of the millions of unemployed finance professionals in China. According to data from China's National Bureau of Statistics, as of December 26, 2024, the total workforce in the tertiary sector reached 264 million, a 25.6% increase since 2018. However, the financial sector is the only industry where employment has declined. The number of workers in finance dropped to 12.35 million, down by 32% compared to 2018, a loss of 5.8 million jobs. The wave of pay cuts in China's financial sector is spreading across major financial institutions, even reaching state-owned firms that were once considered iron rice bowls, stable and well-paying jobs. Recently, Chinese authorities issued a salary cap for 27 state-owned financial enterprises, setting a maximum annual income of 1 million yuan for senior executives, about $137,000. Mid- and high-level managers will see their salaries slashed by as much as 50%. This policy took effect in February. According to Reuters, 3 sources familiar with the matter confirmed that executives earning over 1 million yuan per year will have their salaries cut, with some seeing their income drop by half. The pay reform applies to China's 5 largest state-owned commercial banks: Industrial and Commercial Bank of China, China Construction Bank, Agricultural Bank of China, and Bank of Communications. It also includes 6 major state-owned insurance companies and 4 large asset management firms that handle non-performing loans. 2 sources say that the salary cap will hit department heads in financial firms the hardest, as they often earn more than the chairman, president, or general manager. Under the new rules, chairpersons and presidents will have their salaries capped between 700 and 900,000 yuan, about $96,000 to $123,000. Additionally, the regulation limits the salaries of top executives at subsidiaries of state-owned financial firms, including investment banks and asset management companies, to a maximum of 3 million yuan, about $410,000. Securities exchange filings show that some senior executives at these subsidiaries previously earned up to 5 million yuan per year, about $680,000. One source noted that high-ranking executives at 3 financial regulatory bodies could face even deeper pay cuts of up to 60%. Another source told Reuters that before this reform, a department head at the China Securities Regulatory Commission, CSRC, could earn 300 to 400,000 yuan per year, about $41 to $55,000, nearly double the salary of civil servants in other government agencies. Most of these income reductions will come from cuts to bonuses, making this the most extensive pay cut initiative in China's state-owned financial sector. The affected institutions manage assets totaling $67 trillion, but employees have not been given a clear explanation for the pay cuts. Reuters noted that these salary reductions come at a particularly sensitive time. The Chinese government has been urging people to spend more to boost economic growth, yet this move seems to contradict its recent policies. According to Voice of America, Xie Tian, a professor at the University of South Carolina's School of Business, said that governments at all levels in China are facing financial strain, and central state-owned financial firms are heavily in debt with poor performance. Although the salary cap for financial executives is still high compared to other industries, Xie said the decision was not about reducing income inequality, but simply a response to financial difficulties. He explained, "This isn't about narrowing the gap between financial insiders and ordinary people. The reality is, they just don't have money anymore." Research fellow at the Taiwan Academy of Banking and Finance, Xue Shunfeng, explained that salary cuts in China's financial sector are driven by both subjective and objective factors. However, he believes this is more of a forced response to the current economic situation rather than a voluntary decision. The broader economic environment is a key factor. Since 2018, the U.S.-China trade war, the COVID-19 pandemic, U.S. restrictions on China's technology sector, and economic decoupling have all contributed to a sharp downturn in China's economy. Looking at quarterly data from China's National Financial Regulatory Administration, it's clear that profitability in the financial sector has been steadily declining. Capital returns and net interest margins have been shrinking, while bad debt levels continue to rise. Net interest margin is a crucial metric that measures a bank's profitability from interest-earning assets. According to regulation, a bank's net interest margins, NIM, considered ideal at 1.8% and barely passing at 0.8%. However, official data shows that in the first quarter of 2024, the average NIM for China's commercial banks was 1.54%, down 0.15 percentage points from the previous year. The second quarter remained the same, but by the third quarter, it dropped slightly to 1.53%. Fourth quarter data has yet to be released. The continuous decline in NIM indicates that banks are earning less profit from traditional lending, fueling further concerns in the industry. Xue told Voice of America that even if China's financial regulators had not imposed salary caps and pay cuts at the 27 state-owned financial enterprises, they would have ended up doing it sooner or later. He added that while these income reductions may appear to align with the government's goal of common prosperity, they are primarily driven by economic conditions, leaving financial institutions with no choice but to go in this direction. In reality, China's financial industry has already been experiencing a wave of pay cuts. In mid-2024, Chinese social media was flooded with reports of a 30-year-old female employee at China International Capital Corporation, CICC, who was struggling to pay her mortgage due to salary reductions and later reportedly passed away. Her husband had also been affected by pay cuts. CICC later confirmed an employee's death, but stated it was due to personal reasons. Shanghai-based Yicai Global also reported that salary cuts had become the norm at Chinese banks and security firms due to the country's weak economy. In 2023, management at Chinese banks saw an average salary reduction of 13%. Meanwhile, CICC saw its average employee salary drop to 704,000 yuan per year, a decline of nearly 120,000 yuan, marking the steepest salary cut among 22 security firms. The firm also lost its reputation for paying million-yuan salaries to its employees. Associate professor at Shili University of Technology in Taiwan, Chang Hongyuan, pointed out that salary cuts had already started in 2024. By early 2025, the large-scale devaluation of state-owned banking assets was simply a natural progression of what had been happening beneath the surface. At the same time that China is imposing salary caps on financial institutions, the government has announced an increase in the minimum wage across 19 provinces and cities, raising it to 2,100 yuan per month. According to China's Ministry of Human Resources and Social Security, Inner Mongolia saw the largest increase, raising its minimum wage by 290 yuan, a 15.6% increase. Jilin, Chongqing, Heilongjiang, and Hubei also raised wages by over 200 yuan. Currently, Shanghai has the highest monthly minimum wage in China at 2,690 yuan, followed by Jiangsu and Zhejiang at 2,490 yuan, Beijing at 2,420 yuan, and Shenzhen at 2,360 yuan. From an economic perspective, raising the minimum wage is supposed to increase disposable income and stimulate consumer spending. Professor Xie, however, argued that 2,100 yuan is not a significant amount. It might be enough in some remote areas, but in major cities, even the minimum wage is not enough to cover basic living expenses. Having extra disposable income to drive consumption would be nearly impossible. Xie explained, after deducting taxes, housing costs, and food expenses, there's barely anything left. If people have no disposable income, raising the minimum wage won't boost the consumer market. This is mostly a government talking point for maintaining social stability rather than an economic growth strategy. Research fellow Xue Shunfeng noted that limiting executive salaries at central financial enterprises and raising the minimum wage might seem like separate policies, but they share the same underlying goal: stability. Xue said, "At first glance, it looks like the gap between rich and poor is narrowing, but in reality, this is more about keeping the situation under control." Xue also pointed out that whether it's financial professionals, general workers, or even civil servants, many are now seeking alternative ways to make a living due to job insecurity. This all ties back to China's worsening economy and fiscal deterioration. He emphasized that the key issue for the government is figuring out how to use policy measures to maintain stability. For a long time, the real estate sector has been a major driver of China's economic growth and a cornerstone of its financial system. Banks, trusts, insurance companies, and security firms have all been deeply involved in the property market. In other words, much of the prosperity in China's financial sector has depended on real estate. But with the collapse of the property bubble, financial institutions are now dealing with rising bad debts, shrinking profits, and declining market confidence, leading to widespread layoffs and pay cuts. Xu Zhen, a veteran in China's financial sector, explained that finance is closely tied to the real estate economy, and when industries like real estate face problems, the financial sector quickly feels the impact. Xu said, "For the past 20 years, real estate has played a huge role in driving economic growth, but since 2021, the industry has been in a steep decline. The collapse of Evergrande was a major turning point, sending shockwaves through construction, finance, home furnishings, and 50 to 60 other industries. Conservative estimates suggest that the direct and indirect job losses from this crisis could exceed 10 million yuan. A financial professional in Shandong has turned into a workplace content creator on social media. On December 15, 2024, he posted that 2025 would be an even tougher year for banking professionals. He outlined several key reasons. First, economic conditions and market environment. Slow economic growth, increasing interest rate risks, and intensifying market competition. Second, policy and regulatory factors. Stricter regulatory requirements and the impact of local government debt resolution efforts. Third, banking operations and risk management. Rising pressure on asset quality, the need for additional capital, and increasing operating costs. As financial markets become more competitive, banks must invest more in human resources, technology, and marketing. However, with sluggish revenue growth, profit margins are being squeezed further. Fourth, societal and employment environment. Greater job market competition and increasingly diverse customer needs. Davy J. Huang, an American economist, believes that based on the current trends in the real estate and financial services sector, the outlook for 2025 is bleak. He explained that a substantial recovery in China's real estate market seems unlikely. The financial services industry depends on growth in emerging sectors, but given China's strained international relations, a short-term rebound is also difficult. Job losses in the sector will likely continue. Huang also criticized the Chinese Communist Party's economic policies, saying they tend to be either overly strict or completely hands-off, with no middle ground. He described China's financial and real estate sectors as being mismanaged by policymakers who lack industry expertise, and he pointed to widespread corruption as a major issue. Because both real estate and financial services are highly sensitive to government intervention, their development remains disorderly. These factors, he warned, pose serious challenges to China's long-term economic stability.